Good morning, everyone. Welcome to the next IFS PD webinar on tax deductibility of advice fees. Thanks for joining. We're delighted to have Tangelo Advice Consulting with us today. We've got Mel Drago, who some of you may know as a previous IFS employee, and we've also got Conrad Travis, who's the Director and Principal Consultant, who's heavily involved in the tax deductibility of financial advice, worked with the FAAA and the ATO, so it's great that Conrad's with us here today. We're going to be going through a number of, Conrad will take us through the agenda shortly, but it'll be taking us through the background of where we got to and how we got to this position and some of the intricacies involved. And then we're going to get into some practical guidance that IFS is providing and some tools as well that you can use. This is getting recorded, so it will be available on the Advice Solutions Hub from Monday. Just a reminder that if you stay and watch at least 80% of this, you'll be awarded CPD points, and that'll be accredited to your Kaplan on track as well. So just wanted to kick off with a poll, making sure you all know or paying attention. And what we wanted to I know some of you have been calling for this and calling for a bit of information around it. So we'll launch the first poll. Regarding how your members or clients would value if you could provide them with an estimate of how much of your advice would be tax deductible when they do their tax return. We'll just get a bit of an indication from that straight up. Great, everyone's putting their results in. All right, just another few seconds. And as you can see, it's a good result. Over three-quarters of you highly valued their clients. You think your clients will love it, that you'll be able to provide that information to them. And no one thinks it's worth no value, so that's great. So that's good that everyone's going to get something. All your clients or members are going to get something out of this. So that's fantastic. So I'm going to stop sharing that now. I'll hand over to you, Conrad, and you can give us a bit of an overview of what we're going to go through today. So as you go through that, I'm going to monitor the Q&A. So if there's any questions that kind of pop up, well, I'll try and collate them, and we'll maybe pause a couple of times throughout the session, Conrad, and see if we can answer those.
Great. Thanks, Craig. Hi, everyone. Just Craig, can I just check you can hear me okay?
Yep,
All
all
good.
good. Yep.
Okay. Look, really excited to be here today. It's obviously a subject that I'm pretty passionate about myself, and be great to just talk you through a little bit of the background of sort of how we've got to here. So we'll cover that off. We'll sort of describe what's changed and what opportunities that might present for you and your clients. We'll talk about how we can apply the law to individual client circumstances. And then we sort of want to focus the majority of the presentation on I guess, the practical side of it, which is what can you do from now to generate the calculation to give your clients that deduction that they're entitled to. And then Craig and the team and Mel will go through the calculator that we've built for you. And then we've got time at the end to answer any questions. So that's the agenda for today. So background, how did we get to here? Okay, so just a little bit of history here. I started the Tangelo business back in 2019. I came out of 10 years with ANZ, was there for the Royal Commission, the fee for no service stuff, ASIC notices, all of that fun stuff. And Mel was with me at that point as well. She remembers it well. And when we started Tangelo, we wanted to create a different kind of consulting business where we didn't want to just create beautiful PowerPoints for clients or do file reviews or do what we call bottom of the cliff consulting. We wanted to really help. And so one of the things we identified was we wanted to get involved in industry issues. So I got involved in the FAAA policy committee, but we also looked at this opportunity around tax deductibility. And I had a conversation with Dante De Gori, who was at the time the CEO of the FPA, for those who remember way back then. And we just had a chat about how could we make the biggest impact on advisors' day-to-day lives, given we were just coming out of the Royal Commission. We thought that a change to legislation to make all fees deductible was like it was a nice thought, but it was just never going to happen. So the thinking was, why don't we attack the existing tax determination, which is TD 9560, which was the previous one. So that tax determination hadn't been reviewed since 1995. So forget about FSRA. It didn't even contemplate FOFA or anything like that. So it was clear that it needed updating. And we also knew that the ATO, let's just say this politely, would need help with what modern financial advice looks like in terms of the education process. So we kicked that off. The FAAA agreed to fund it. We brought in Deloitte as tax partners. We got tax controversy partners to support the project. And just summarizing, 6 years, we went through, I think, about 40 different meetings. We produced, I think, three really detailed and high quality submissions as to why it could change. The ATO produced, after a couple of years, its first draft of the new determination. We went through it and said it was could do with a lot of refinement, put it that way. And bear in mind, halfway through this project, the entire project team changed, and we got a new group of people that even ask questions like, "Financial planning, is that just stock picking?" So I remember going through that. We got a lot of feedback from advisors. We got advisors involved in the examples. We again reviewed an additional copy of the TD that we got in 2023, which went out publicly as a draft, and then in 2024 we got the final version around September last year. So that tax determination is live now. The previous tax determination is no longer exists, and this is live for you to use right now, including the ability to claim fees previously charged. And we'll talk about that in a moment. But that's the backstory. If you are an FAAA member, I would say this is one project where you should not be cynical, where they have had your back and really, hopefully, I think you can see will have delivered some value for you. So what's changed? Just going through the key points here. The new tax determination excludes fees deducted from super or paid from a trust or company. So obviously fees that are coming out from super, it's that tax paid environment. So we can't double dip. So this includes fees that are I guess paid directly or fees that are coming out from IDPS, WRAP, Master Trust, etc. The upfront fee under Section 8.1, I'll explain what Section 8.1 is in a moment, is still seen as capital in nature and mostly not deductible. But the win for us is that we do have a deduction available for upfront fees under Section 25(5) of the Income Tax Assessment Act, proportional to the amount of advice related to managing the client's tax affairs. So that is the new thing that has changed. And what that means is that you can claim for the client the part of the upfront fee which is related to the managing tax affairs definition. Now, we think last year when this was released, a lot of people were confused by the TD, which I'm not surprised by, and people kind of slept on it and thought it wasn't that much of a win. But we think it is quite a big win because a lot of superannuation advice, a lot of investment advice is tax related and will be deductible based on this principle. Ongoing fees, the only major change there, I know that's not as relevant for you guys, but you can either have a link to assessable income and or managing tax affairs. So there's two ways to make ongoing fees tax deductible, but not a lot has changed around ongoing fees. It's pretty similar. The fee in relation to insurance advice. So this is not so much the premium that you charge for insurance, but the fee in relation to, for example, holding income protection inside and outside of super. That is now deductible under Section 8.1. And as I mentioned before, the TD is live and can be relied upon. One thing to call out here is you must be a qualified tax relevant provider to access the 25(5) definition. So hopefully this is the value of you guys doing all these crazy TPB courses that you've had to do over the years. So what is tax financial advice? So it's kind of defined in Section 9015 of the Tax Agent Services Act, 2009, and it includes advice about things like liabilities, entitlements, or obligations under a tax law that a client may rely on to satisfy their obligations or claim entitlements. And it's also provided in the course of giving advice, usually given by financial advisors. Financial advisors, because they are QTRPs, are what we call tax financial advisors, which is a term actually enshrined in law. And what are some examples of tax financial advice? Obviously, we're going to go through this in a lot more detail in a moment, but things like superannuation contributions, because that's covered by the SIS Act, that's deductible to an extent, and we'll explain that. Any work that you do around capital gains tax planning, that would be deductible. Structuring insurance inside and outside of super, as I mentioned before, that advice is deductible. There's some elements of debt advice, depending on what it is, that can be deductible, and investment structuring for tax efficiency. So when we talk about ETFs or insurance bonds or things like that, there's definitely elements of the way that you structure your investments that will meet the definition of managing tax affairs. So that's what we're talking about when we talk about tax financial advice. So just going into a little bit more depth here, I know you probably hear these terms, Section 8.1, 25.5. What does it actually mean? So we are talking about the Income Tax Assessment Act from 1997. That's the area of legislation that's relevant for us today. The first one, Section 8.1, this is what we call a general deduction. And it talks about you can deduct from your assessable income any loss or outgoing to the extent that it's incurred in gaining or producing assessable income. However, you cannot deduct a loss or outgoing under this section to the extent that it is a loss or outgoing of capital nature or of a capital nature. Now, we spent most of that 6 years debating with the ATO this point around capital and nature. And look, our view was that you don't have clients that come in with a bucket of cash that's just sitting in a bank account that you're looking to invest. That in reality, clients have superannuation, they have investment accounts, they have they might have an inheritance. They've got bits and pieces everywhere. And our view was that those assets are already income producing in nature. Therefore, it shouldn't be regarded as capital in nature. But the ATO didn't buy that, and we got this ruling that the changes the view from the ATO hadn't really changed under 8.1, that the upfront fee was mostly capital in nature and therefore not deductible. Where we did have the win was, like I mentioned before, under 25.5, the costs incurred for you to manage tax affairs. So in this definition, you can deduct the costs associated with the fees associated with managing tax affairs if that advice is given by a recognized tax advisor, which includes a QTRP. So that's the new part. So when should you use both of these? Look, our kind of advice from an IFS perspective is that is not to really worry too much about 8.1 in terms of your upfront advice. There are rare examples where it can apply, but it's going to be so minor in nature that you're really better off focusing on 25.5 for getting the deductibility for your upfront advice. Tax affairs has a broad meaning. We're going to go through some examples later just to explain it further. And not all your tax advice, or not all your advice will be considered tax advice. There'll be a proportion of the advice that will be and a proportion that won't be. And we're going to give you a calculator to help you estimate that. The taxpayer must be able to identify the payment that was for advice to assist them in managing their tax affairs. So that's why we're going to need to produce some documentary evidence to give to them to keep on file, and for yourself to keep on file, just in case it's questioned in the future. Obviously, also working with the client's accountant very closely. We do think, just to that point, that it's better for financial advisors to drive the understanding of what's deductible and what's not. I would say, having worked with the accounting bodies on the guidance that came out from the FAAA earlier this year, that the understanding of some of these strategies is not always as high as what you might think from the accounting bodies. So it's better for us as a financial planning community to drive that understanding, in my view. In terms of ongoing advice, so both Section 25.5 and 8.1 are available to claim a deduction for a client. So this is more of the same. So 25.5, tax-related advice, advice on tax liabilities and entitlements under the law. So as I mentioned before, a lot of the super strategies, and Craig and Mel will go through this shortly. Insurance structuring, capital gains tax. There's probably too many to mention here. Like, this is not exhaustive, obviously. And look, what is Section 8.1 talk about. So this is more like that ongoing investment advice where you've got a client producing income. Obviously, it needs to be accessible, so they need to be within the tax system. And then advice around income protection insurance, not just income protection insurance. There's also things like buy sells and insurance advice that relates to business insurance that could also be deductible from an insurance point of view. Both laws may apply, but you can't claim twice. If there's any doubt, Section 25(5) takes priority. Um, and the phrase "to the extent" means that we must apportion the upfront fees appropriately, which I'll go through in a second.
Yeah, thanks, Conrad. That's a great background about where we're up to at the moment. We're just going to put out a poll question. So before you give us the answer, Conrad, we wanted to just see where everyone's at in terms of their understanding about how to determine the method of claiming that tax deduction. So I'm just going to quickly launch a poll. And which one of the following is not listed as an appropriate method for you to claim a tax deduction? Now, you may or may not know the answer to this, depending on how much you've kept up with the ATO um, details. But if you can just have a go and give it your best bet for those that aren't quite sure, and then Conrad will kind of go over the answer with us shortly. But yeah, as I said, Conrad, that's a great background, and just about all our advisors are qualified, tax advisors, QTRPs, so that shouldn't be a problem. Obviously, we've got till the end of the calendar year for everyone's education, including tax status. So um, we've got a handful of advisors that are still operating under the grandfathered rule until they have to complete an approved commercial law course and tax law course, but I think they're well on the way. So
Yeah, well, this might
um,
make the motivation a bit stronger.
yes, yeah, that's right. Well, yeah, just about everything's relating to tax, isn't it? So you really do need
Yeah.
to have that ticked off. All right. This is some interesting results. I'll just end the poll now and share the results on the screen. Um, so it's fair to say that our advisors haven't really been maybe paying a close attention to this. I think they've known what's been going on in the background, but really haven't been getting right into the detail. So I think this next section, Conrad, they're going to get a lot out of this. So I'll
Yeah,
stop
maybe
there.
they've got better things to do than read a 40-page guidance document by the sounds of it,
I
but
wouldn't have
that's
thought
okay.
so. No, I wouldn't have thought so. All right, I'll stop sharing that, and you can go through the different methods.
Okay, great. Thanks, Craig. Okay, so in the FAAA guidance, which I actually project managed on behalf of the FAAA, which included the three Australian accounting bodies and feedback from the Self-Managed Super Association. So that is the reason why it took so long, just to be frank, is that we needed to make sure that it was a united industry approach. We didn't want to release something and then have the accounting bodies come back and say, look, that doesn't make sense. They had full visibility. We also ran it past the ATO, which is probably an important point. The ATO obviously wouldn't endorse it or publicly say anything about it, but they have reviewed it and we've included minor feedback from the ATO. So the three methodologies that we did come up with, and there may be further methodologies in the future, is firstly the strategy basis, secondly the activity basis, and thirdly the insurance premium basis. The strategy basis we're going to go through in detail today because that's the methodology that we're going to launch to IFS. We think this will be the most common methodology used. This is where the split of deductibility is based on the actual strategies recommended to the client. And each of those strategies would need to be assessed as whether they meet the definition of managing tax affairs. So that's going to be the main one, I think, used in the industry. We did include the activity basis, and this is on the assumption that some of our accounting friends also are financial advisors and may have accurate records of their time. You'd need accurate records of your time to use this methodology, but it would need to break down like the time that you spent on the SOA, not just the SOA, but the planning process, and what time your support staff, and trying to divide that up versus what is tax related, what is not. So that'd probably be quite hard based on what I know about record keeping for financial advisors. So sort of take it with a grain of salt. The third one we included for our insurance advisors who obviously struggling a lot with the LIF changes, and the industry's been decimated. We really wanted to encourage more people to give insurance advice, and a lot of insurance advisors don't charge an upfront plan fee. I think it's crazy, by the way, because I think they're paying for the advice and they should charge an upfront plan fee. And this change, we think, will allow insurance advisors to maybe look at a $1,500 or $2,000 upfront plan fee, because particularly if they include income protection in their recommendations, up to 50% of that fee would be likely to be deductible, given how much work goes into IP estimation and claims further down the track. So we do have option 2 and 3 available, but today we're going to focus more on option 1, and that would need to be included in a deductibility summary, and we're going to go through exactly how to do that in a moment. So, by the way, all of you that answered pro rata before, I guess in some ways you're not wrong because all of these are pro rata, but that wasn't one of the methodologies that was in the FAAA guidance. So I just wanted to go through a little bit of a case study here. This comes directly from the tax determination, and this is the example that gives us the precedence for why upfront fees are tax deductible. So Claudio is a recognized tax advisor. So this is QTRP. She's given advice to a client who is Australian resident who earns a salary and has savings in an interest-bearing account, who is a member of a super fund. She's seeking advice to enable her to increase her income by generating higher returns. You can see that some of these examples are a bit cheesy because it's like sort of when you choose the example like in an exam that fits the mold versus like real ones, but you've got to work with what you've got. So Claudio recommends that Minji invest her savings in a managed fund, which provides a periodic return. This includes advice in relation to tax, advice about liabilities, obligations when acquiring and holding and disposing of this investment. So what's deductible? The recommendation to acquire the units in the fund is not deductible under Section 8.1 because the fee is incurred as part of putting the income earning investments in place and does not have a sufficient income connection with earning income from the investments. Like, I obviously disagree with that, but that's what the TD says, that this is capital in nature and therefore not deductible under 8.1, just to be clear. It can be included, this is another point, in the cost base of the investment for capital gains purposes. However, tax financial advice in relation to the implications of the investments in the specific fund is deductible under Section 25.5 because Claudio is a recognised tax advisor and was providing tax financial advice. So she draws up an invoice and apportions his total fee between the different components of the advice on a fair and reasonable basis. So hopefully that makes sense. That's an example that gives us the precedent that part of the upfront fee is deductible to the extent it relates to managing tax affairs. So what do you need? An itemized tax receipt. If you are doing an invoice, you can have this estimation sort of supplement or support your invoice. You need an estimate of what's deductible, an explanation of the advice provided, the date the expense was incurred, and the supporting invoice, which you would have as part of your normal process. So those are the kind of documentary pieces of evidence, which all will be tied up into the solution we're about to release and give to you in a moment. Okay, Craig, do you want to hand over? Yep.
Great. Thanks for that, Conrad. Yeah, that's great background, as I said. And as I mentioned earlier, I know a few advisors have been asking about this, wanting to know a bit more and getting IFS's a view on it. So that's where we've engaged Tangelo, gone to the experts, and worked with them to come up with our guidance and our policy, which will be available on the Advice Solutions Hub from Monday, as well as some of these tools that we're about to go through with you as well. Look, it's great to be able to provide the advisors with all these extra tools and extra guidance. Obviously, as individual funds, you'll give different uses out of them, and as teams, you'll need to discuss it with your leader about what the best approach is going forward. But we've tried to make them as practical as possible, and as Conrad said, there's one particular way of coming up with the tax deductibility, the strategy basis, and so that's why we've built the calculator around that type of basis, because that's going to be the easiest, I think, for you to use. But I'm just going to launch one more poll question before I hand over to you, Mel. I know you're itching to go.
Thank you.
Um, The last one is just some examples. Just before we are going to go through some examples, and Mel's going to demo a calculator as well. But I'm just going to launch this one again. We're going to go through some examples and probably make this even clearer. But if you can have a go at this question, which of the strategies are generally not at least partially tax deductible for individual clients? Got four choices there. One of them is not partially deductible, tax deductible for individual clients. If you can have a go at your best guess for that. All right, just wait another few seconds, get the last few poll results in. Don't worry if you get it wrong. That's the whole point of this webinar and the whole point of these next few demos that we're going to be using. And that's obviously why we wanted to give you some supporting tools to be able to help you come up with what is deductible and what is not. Okay, so I'm going to end the poll there and share the results. So a bit of a mixed bag. Um, Look, I can understand that first one actually. Although it is partially tax deductible. And it kind of confused me a bit too, Conrad, when I first kind of looked into that. Do you want to just briefly explain why a non-concessional contribution could come under managing your tax affairs as tax deductible?
Yeah, and like I think this is where need to just separate out the advice itself as the event versus the impact of the advice.
Hmm.
And that's really the key point is that yeah, like non-concessional, I get it. So like at a high level you'd go, oh, that's not tax related, but the fact that you're giving advice in relation to that and you might have considered, whether it's concessional or not, you might have done some tax planning around it. So there's tax considerations that go into it, even though the outcome of it could may not impact the client's tax situation. So therefore, on that scenario, a lump sum non-concessional could be, and again, we need to make sure it's relevant for each client situation, but that is tax related and therefore partially deductible.
Yeah, yeah, you're making an assessment whether or not to move it into a different tax structure, whether they're going to be falling under different caps, as well as their total super balance, et cetera, et cetera. So I suppose that's the kind of the basis why it broadly falls under the managing tax affairs. So not 100% of it, but part of it, and we'll get into that as well. So now the correct answer was retirement advice because it was all getting coming out of their super account, and that's why you can't claim a tax deduction because they're not paying for it personally. So Mel, I'm going to hand over to you.
Over to me.
And you've been helping us with these policies and tools. And I'll just allow you to share your screen so
Thank you.
you can take over from there.
Great. I'll go straight to now. I'm going to switch between PowerPoint and Excel, so I might have to leave it on this screen so I can see everything.
Mhm.
Can you see my screen okay, everyone?
We can see your PowerPoint. Yep.
Great. Um, so this is the policy that will be on the internet. Craig, did you want to talk about that more or
Yeah, just
switch?
briefly, yes. So this is so we're going to have a very kind of high level overview on the Ash page, just straight on the page under the process. At the moment, we've got process and some guidance around your advice fees, and then there's going to be a new heading called tax deductibility of advice fees. And within that, that's going to link to this document that you've got on your screen. So that's going to be living in the document library, the tax deductibility of advice fees, and it's also on a kind of it goes into a lot more detail and also doubles up as a bit of a guide on how to use the calculator that you're about to take us through. And you've also done a video, Mel,
Yes,
on
I
how to use
have.
the calculator as well.
Yeah, so don't stress everyone when you're going through this today and you're thinking, oh, I've just bamboozled you. I've recorded a video and I went through everything so you can watch that. It's only about 10 minutes long, so you can understand how the calculator works in a bit more detail. So don't stress if you are not totally over it by the end of today. Okay, thanks, Craig. So
Mel,
what,
I
hello
reckon I might
everyone.
need to stop sharing and then you share yours. Sorry, it's still got the PowerPoint from my presentation
Oh, no,
inside.
I think for us it's okay, Cameron.
Okay, sorry.
We can
My,
see, well, I can
my
see
bad.
Mel's is fine. Yeah.
I'll go back in my
Can you?
box. Sorry. Yep.
Yeah.
That's right. Hi everyone, nice to see everyone again. I think I'm far away, but I'm here. Um, Today I want to go through this tax deductibility calculator, and I think the biggest thing and challenge that you're going to get is what proportion of the strategy is tax deductible. It is confusing and there's no set science on it. There's no formula. It's really a judgment call. So I want to go through some examples today of the ways you could approach the tax deductibility calculations. Craig has gone through all the strategies in this calculator and set a default for what they think is the licensee position on all the strategies. So you can always talk to Craig about how he came up with that number and he can help you there. But I'll sort of go through the case studies today and explain my thinking and how I think you could approach each strategy. So, and if you have any questions, just pop your hand up because I'm aware that as I'm going through, you might have some questions. I'm happy to answer them as we go through. I've got a question from Adrian, so I'll go through your question, Adrian, when I'm going through the calculator. So the first case study I've got today is just a simple one. It's James. He sought advice on investment choice in his super fund, and he also wants to do salary sacrifice contributions, which I'm sure you all do a lot of the time. The advisor recommended to maintain his super account and switch to a high growth portfolio. So, based on his situations and needs, the advisor also saw he had some surplus income and decided to contribute, I should be $100 per month into super. Now, the advisor charged $1,700 for this advice and it was totally paid by James, so paid directly. So, I'm going to switch now to the calculator and show you how that works. So this is the calculator that you'll have available on the intranet. Now it's got macros in it, so don't be emailing it out. It won't go anywhere. So you'll have to download that from the intranet and save it on your computer. Now, when
So,
you first
sorry,
open the calculator, there's a couple of things.
sorry, Mel. Have you got the, we
Yeah,
still
go
see
for it,
your,
Craig.
you're still seeing your PowerPoint slides? Are you showing your calculator?
Oh, really? Okay, hang on. I
So,
knew
and
that would happen.
just,
Wait
yeah,
one
just while you get
second.
that, just while you say that, yeah, so we are going to be putting the calculator on the Advice Solutions Hub. There is in some instructions in that guide that Mel uh, showed earlier about how to download it and enable the macros. So we were able to do it fine here. We just had to follow those instructions because obviously your IT security might, as a default, try and block the macros. Probably will. So you probably have to just follow the instructions in that guide about how to enable the macros. Obviously, it's a trusted source coming from us, so that shouldn't be an issue. But yeah, hopefully you've got the permissions yourself to be able to do that. But worst case scenario, you might have to speak to your IT if they have to enable the macros for you. But Mel, yep, we can see your screen now.
Yeah, we can see your screen, Mel. Sorry.
Great.
Yep.
Perfect. No, great. Thank you. Is it big enough? Can you
So,
see
yeah.
it's big enough? Okay,
Yep.
that's the other issue I usually have. Okay, great. On the right-hand side, you can see there's advisor details there. Anything with the green highlight is bits you can fill in, essentially. So what you'll need to do is enter your name and email address. The industry fund services is hard-coded, so don't worry about that. Down here is your business address, your fund name, your fund phone number, and you can also add in your fund logo. So have a JPEG ready. And to do this, I've given you little instructions here on how to do it, but you click into the cell and insert a picture into the cell. So do that. I know it looks really tiny here, but don't worry, it grows when it goes on the other side. So this picture and your details are going to populate the output of this calculator. So make sure that is a good image. You can also put your signature. If you've got a digital signature, a picture of your signature, pop it in there. That will also go in the letter. Don't be too concerned if you don't. You can just leave that blank. So once you put that information in there, you can save this calculator, and I recommend you saving it as an Excel template. So you'll have to save it as an macro-enabled Excel template. Go to the guide and it shows you what that is. But that way, when you open the calculator, you're not overriding information. It opens up a new sheet for you every time with your details in it. So if you can do that, that'd be good. The only thing you should do is just be aware if there's an update to the calculator. I'm sure Craig will alert everyone to the update, and you just have to make sure you download the latest version. There'll be version numbers so you can keep track of that. Okay, so once you've done your advisor details, you're ready to go with the client. So what you need to do is enter the client's information, and we've got their name, entity ID for Xplan. So this is pretty cool. What we've done is we've made it so you can actually send the output straight to Xplan via email, and it goes straight into the file notes of Xplan. So you'll need to do that is to get the entity ID, and hopefully everyone knows where that is in Xplan. Can I just see some hands? And that's all fine. Because if you don't, just talk to Jeremy and he can help you. But you'll have to copy that entity ID and pop it in there. If you don't want to do that, just don't put it in there. That's fine. Okay, now we're going to the fees. So this slightly confusing, but I'll try to explain it. The advice fee is the total fee that you're recommending. So in this case, $1,700. If the client was to pay a portion of that fee from super, you would put what's paid from super. So let's say they put $550 from super. So then the fees paid personally is what's eligible for a tax deduction. So keep that in mind. Any fees paid from super is not tax deductible, so we have to remove that from the fee, and that leaves us with the balance which we can assess for tax deductibility. Hopefully that's all okay. So in this case, he's paid it all personally, so we've got $1,700 to play with. Moving down the bottom here, you'll see the date of advice. So just put in the date of advice, and it's the date of the SOA. And then over here, I'm getting my internet's unstable, so hopefully you can still hear me. You'll have the financial year will calculate automatically for you. The other thing is invoice ID. Again, this is just an optional inclusion. So this is for audit purposes. And if you want to just track where this calculator and what invoice it's relating to, you can put the invoice ID there as well. Now, if you need help, we've got some help text down there that you can refer to. Also, the guide's really good for helping as well. Okay, you've done all that, you're ready to go. Now let's do the calculator section. So switch over to the next tab and you'll see some common strategies on the left-hand side. So these text tick boxes will drive the drop downs here. And what we've done is we've tried to separate out your main strategies. So Craig has kindly given me a list of all the strategies that you recommend on a regular basis, and you'll find those in the IFS Common Strategies tick box. If you can't find the strategy in there, it's definitely somewhere else. So just tick another box and you'll find it in that list. The reason why I've done that so you don't scroll 100 different strategies and can't find anything. So it's just separated out for you. So once you tick that box, then you'll get the drop down moving to what strategies you can select. And as Craig pointed out earlier, this is a strategy basis apportionment method. So that means we're going to put all the strategies recommended in the SOA so we can apportion the advice fee to that strategy. So you can't, as Adrian, you had a question, what if we leave stuff out? Is it going to make more tax deductible? Yes, you can't leave strategies out. You've got to put in the recommended strategies in here. So even if it's estate planning, that is a strategy that was recommended. You have to include it in here so the apportionment's right. Or we suggest you do. I mean, if you don't, you might get in trouble, but recommend you put all the strategies in here. Anything that, and Adrian had also another really good question. What if you put a strategy in the projections, for example, paying off debt in 20 years' time or 15 years' time? Conrad can probably answer this as well, but in my opinion, that is an assumption for a future strategy. It's not advice at this point in time. And so you should include advice at this point in time. Even maybe next year, if you do salary sacrifice for next year, that would be okay. But something 10, 15 years out is more of an assumption for projection purposes.
Yeah, correct. Yep.
And
Does
just on
that
that,
answer
Mel?
the question? Yeah. Does that answer the question? Yep.
Yeah, I think so. And Mel,
Sorry, Craig?
yeah, so this, the weighting in advice, this is kind of it comes a little bit to what you were saying before, Conrad. It's not hard and fast rules here in terms of you're going to have to make a judgment call about how important this is based back to the client goals. Is that right? Is that how you would explain it? Or how?
Yeah.
It's very hard to come up with those numbers, I think, and so the advisors are going to really have to just think about how important that weighting is relevant to each strategy, and then
Yeah.
Mel, the calculator looks for 100%.
Yeah,
To
look, I'll get Mel to explain the personal versus super bit in a second, that column C, but column G, that was included because we want you to think about how important that strategy is relative to the client's goals and objectives. So we don't want you to change how you're giving advice today. You should give it exactly the same way. You shouldn't try and reverse engineer deductibility. But what it means is that if you are recommending, for example, the client gets a budget or estate planning, it's not going to be, in most cases, the main part of the advice. The main part of the advice will be about how they can accumulate wealth or prepare for retirement. So you can weight those a lot higher based on your personal judgment relative to the client's goals and objectives. So the last thing we wanted to do is provide four strategies and just weight it 25% each because that wouldn't be bespoke and relevant to the client. So there will be some judgment in that. But with other clients that we've rolled this out to, it's actually been really helpful to think through just as a standalone exercise, what is the main part of the advice, Craig?
Great. Question about can it be integrated with the SRF, your next
Yeah.
plan?
I've just answered that, Mel. It's something we can look at down the track. It's a good
Phase two,
Yeah,
idea,
call it
but
phase two. Yeah.
I
not,
think in
not day
that
one though.
for that to work, well, perhaps it'd have to be more of an online tool, and that way we could sort of do some integrations this way. Remember, this is an Excel spreadsheet, so integration is kind of limited when we're working with Excel. But in saying that, it doesn't take very long to do the calculator, so don't get too concerned. It'll literally take you 5 minutes to do it. So all you need to do is select the strategies with the drop-down box, who the advice is attributed to. So this is who the advice is for. So if there is two clients in this calculator and you're doing salary sacrifice for both, you're going to have to put salary sacrifice twice, put one to the first client and one to the second client. Now, the fee paid from is whether it's personally paid or super paid. Now, the reason why this is here is because if you do say attribute some of the fee to super, so being paid from super, then obviously some of the strategies that you've recommended in that SOA was attributed to that fee that was paid in super. And so we can't double up and then include that as part of a personal tax deduction. So what we need to do is tell the calculator which strategies have you apportioned and put to the super advice. And remember, you've got to keep in mind sole purpose and all that sort of stuff. But I'll talk about this in the next example, that super column. So just bear with me. So we just have to say who's paid for that strategy, personal or super. The next column, details relating to strategy, is purely for you. So this is so you remember what you've recommended for the client, and if you have to pull it up in the next year or whatever, you can see what that was relating to. So just make your own notes there.
Well, Mel's just breaking up a bit there, Conrad. I'm not sure.
Mel, can you hear us okay? You just sort of we're breaking up there. Maybe I can just sort of describe what's going on here. So we're just completing the green columns.
Now,
Oh, can hear.
we're going to the calculator bit. So the default
Sorry,
deductible
Mel, do you want to try just turning your video off? You're just breaking up a bit. I'm not sure if that'll help or not.
what he thinks. So
Mel, can you hear us? Can you just turn your video off and just see if that makes a difference?
Looks like Mel's totally frozen now. But as you're saying, Conrad, fill in the green bits.
Yep, we can include the weighting to the advice, which is what I sort of referred to before. And then that will produce an estimate of what is deductible. And maybe if I can just go back to the PowerPoint, I'll show you the
Yeah.
output. Sorry about this, by the way. You can put this in your feedback. Useless at technology.
That's
It will give you that the letter that will go or can go to the accountant. So there's a letter that comes out of this. There's a button that you can push that will say to either the client or the accountant, depending on who you're
yeah.
dealing with.
I think it just says save to PDF.
Yep, and then
And
you can
and
save that output into Xplan. If you've got the Xplan ID, it'll do that automatically. There's one version where it has a detailed summary of what is tax related and why. And then there's another one that has like a summary version of it. So you can click a button to say either version and then provide that to the client or the accountant. So that should all come out nice and simply from the system. And all you're having to enter is, I guess, what's in these green boxes here to get that output. Um, we should say that the default basis for tax deductibility is something that we've given IFS a view on, and IFS has then put their licensee overlay on and put some thinking into what would be the default percentage for each of those strategies. So that's going to come up automatically for you. And then relevant to your professional judgment, you can override that potentially, but you will need to document why you might want to override that, Craig.
Yeah, so that's right. So we've put in some defaults there, which we think will probably be applicable the vast majority of times. We've got some instructions in that guide if you want to change it and what you need to do to justify that change. That's fine. It might be applicable, but you obviously just need to document that. So just in relation to that comment about it, it does seem a lot of work. Look, you to come up with a tax deductible estimate, we're going to have some kind of basis. So I know, going through this calculator the first time, it can seem quite complex, but as Mel said, it really only should take a few minutes. Once you've done it 2 or 3 times,
Yeah.
once, I've had to play around with it, obviously. And once I've done it a few times, it's pretty easy after you've done it the first couple of times. It's only the sections in green. You hit save to PDF, automatically generates the letter, automatically saves to Xplan, and that's all you need to do. So we're not saying that you need to save the calculator into Xplan because the basis is on that letter. It's a 2-page letter. On the second page, it kind of summarizes what's on this page here. So that all that detail is already in your letter to the accountant or to the client who, if they do their own tax return. Um, so
And
that,
what
yes,
I'd say to that, Craig, is
yeah,
also like with other clients where we've rolled this out, similar kind of process. They're sort of claiming between 40 and 70% of the upfront fee. So I'd expect it for accumulator clients where there's a lot of superannuation type advice,
hmm,
it's going to be in the region of 50 to 60%. So like that's not a bad outcome for a client where it doesn't cost the advisor anything. And it actually could really help with, well, and this has been the case with others, your conversion rate. Because if you can talk to the client about this, we are going to give like a one-page summary, I think, for clients as well that they can use,
yeah,
um, and it should impact on hopefully on conversion rates because if you're paying a $4,000 plan fee and $2,000 is deductible, that's obviously going to influence your decision to proceed. So I understand the point about complexity, but really once you're used to it, it should take no more than 5 to 10 minutes per client. Upload to Xplan done.
yeah. No, that's right. No, I probably should hopefully take even less if it's a fairly straightforward one. We don't tend to have too many really complicated scenarios. And it's also, it's something that really, as an advisor, you need something to support why you're making an estimated of tax deductible. And as I mentioned at the very start, this is an extra tool available to you and your members. We're not mandating the use of it. We're saying this is an extra, if you did want to go and provide that to your members and your clients, this is something we're providing at kind of at no additional cost, just something else you get from IFS.
Yeah.
So it's really something that you need to talk as a team about with your leader about in what scenarios. Obviously, if you're not charging the client any direct fees that they're paying for themselves, well, there's no point using this calculator because it's going to come up zero. It's only for the ones where you are charging obviously an advice fee and they're paying for some or all of it out of their own money. Then I think the clients would really get a lot of value out of that. Now, I, th I
Sure.
think Mel's trying to get back in, but I can't see her name here to let her back into the meeting, so I'm not
That's
sure.
okay. Should we just go through these case studies, Craig? Or
Yes, that'd be great if you can. Did you want to talk to those?
yeah, we can maybe tic-tac a little bit.
Yeah, yeah, great.
So in this situation, James Gardner has sought advice on investment choice in his superannuation account, as well as starting salary sacrifice contributions. Salary sacrifice was a higher priority for James. So that's the main part of the advice. That was what we were talking about before with that column that sort of attributes the value of the strategy relevant to the client's goals and objectives. So the advisor recommends to maintain his super account and switch James to a high growth fund. Based on his situations and needs, the advisor also recommended he contributes $100 to super via salary sacrifice. The advisor was charged an advice fee of $1,700, and this was paid personally by James. So being obviously having the fee paid personally is the main part of the advice there. Um,
Oh, I'm back.
Oh, there you
oh
are.
yeah.
Sorry.
Oh, sorry, I was writing there and it was like it wasn't going through. Okay.
So Mel,
You
we're
want me
on
to
case study one now on the PowerPoint.
Yep.
We've just gone through that. So we've just explained the advice fees mostly in relation to the salary sacrifice. So do you want to comment maybe about, we've said here the advisor's charge an upfront fee of 1,700. So like a good portion of that would be deductible because of the sell sac recommendation, right?
Yeah, correct. So if I do you want me to show my screen?
Oh, I'm nervous, but
Yeah,
okay.
go for it.
Yeah, no, I've switched to another one, so hopefully that works a bit better. Okay. So in this case, I've said the weighting in advice is, I'm sure Conrad spoke about this, 80% for the salary sacrifice. We can see it's a higher deductible amount, which is good for the client, and 20% is for the rollover, because the saving for retirement was the most important thing for this client. So in this case, you can see up here that the estimated tax deductible amount is about $1,200, which is really good if they're paid $1,700. Um, any questions on that one?
No, but it might be good, just Mel, we didn't quite get to see the letter output before your technology issues kicked in. So
Oh
can you
yeah,
just,
sure.
yeah, maybe show the guys that?
Yep, so the letter will include this information here. So that's the default basis for why you've recommended a tax deduction. The letter is here in the calculator, so you can have a review of that, and I'll show you the output in a moment. So it just talks about what's tax deductible. And then it also has the breakdown of the advice strategies and the percentage or the proportion that's tax deductible. And it will look something like this, and I'll switch over to the actual output. So the output is a PDF. It prints both pages for you automatically when you press the button. And it looks just like this. So all you have to do is click that button and it'll export it and you can save it somewhere. If you click the send to Xplan function, it will bring up an email client, so a little pop-up window, and then you can send it to, it won't do it automatically, so it'll give you some control, but it'll pop up that email and you can send it straight to Xplan if you've got the entity ID as well. So we'll put this PDF, not the calculator, into Xplan.
Yeah, and that, I'm not sure if you're on the call there before, Mel, but as I've just mentioned, so because it has got all the details in that letter, there's no we're not having a requirement that you need to save a version of that calculator every time onto Xplan. So there's no further requirement that you go in and save the calculator into Xplan if you're saving this letter with the saving this if you're saving this letter with that with that second page, which would, as you said, can automatically happen if you put the Xplan ID on the form.
Yep. I will now switch to case study 2. So let me just go back to the PowerPoint.
So just a couple of questions that have come up that we might as well cover off now, Vitali. So Mel, on that calculator, it does show what the IFS default systems will be. So as you select each strategy, it'll come up with the percentage that is tax deductible. So, Vitali's got a question about, let's say, non-concessional contributions. For us, it's going to be 50%. That's our default. If you're starting an account-based pension, 70%. So I'm not going to go through them all because there's a lot of strategies, but if you have a look on that calculator, when you put the strategy in there, it does come up.
So
It
if I
does
do
come
not
up for each one, so you can have a quick look for that. Prabhath doesn't provide two letters if advice for a couple. Mel, it just provides one letter, but it breaks it down between the client and partner. Is that correct?
Yeah, correct.
Yeah, yeah.
If you want to do the clients separately, I recommend that you do two calculator. If
Yeah,
you
do
the
two
clients don't
calculators.
each other's,
Otherwise, if you
yeah,
put them in
that's
the
right.
same calculator, we'll just have a letter, but it will break down what the difference is between the client and the partner.
That's right. If it's a couple.
And then the other question is about, what's the requirement again? That's up to you and your leader to discuss. And if if your leader's got any questions, they can come back to me with any further questions. As I said, this is an additional feature benefit that we're providing to the funds that I'm sure the members would get a lot of benefit out of. So speak to your leader if you've got an issue with that, and leader can come back to me.
I would say one thing is not to be overwhelmed by the complexity, because for me, there's code of ethics comes in here around doing what's best for the client, and this is certainly something which won't cost you anything, and if it eventually takes you no more than 5 minutes, I would say to investigate and work out how to adopt it into your process, because it's a fantastic benefit for the client.
Thank you.
Now I'm going to switch over to, is that working?
Yep.
Yes, case study 2.
Great. Technology
Yay.
back. Okay. So Holly and Hart, so this is a couple situation, and I also wanted to take a portion of the fees from super so you can see how that works. So in this case, the clients have got an inheritance from a very rich auntie of 200,000. They want to contribute to super as they've got surplus cash flow, and we're also reviewing their underlying investments in their super fund. So the advisors recommended they roll over their super, they change their portfolio, they set up salary sacrifice each of 8 grand, and they also do a non-concessional contribution of 100 grand into super. In this case, the client advisors charged 4,400, but he split the fees between the two, and they've also decided to pay 660 from their super fund because of that's the amount that they decided to put from super. Okay, so let's switch over to the calculator.
Mhm.
And everyone can see that?
Yep.
No, it's all
I'm
working.
back.
Great.
I'm
Yeah.
back, baby. Okay, so we got Holly and Harvey, and you have to make sure you tick the client. Now, it'll grey out so you know you haven't ticked it. Then you have to put the fees in. So as we said before, it's split between the clients. We've got 2222 and 660 is coming out from super, leaving us with about 1,500 bucks that we can claim a tax deduction on, possibly.
Sorry, just Mel, real quick, that split between the client and the partner, that'd be based on normal apportionment rules that IFS would have. I imagine, Craig, is it based on FUM or things like that? So it's not all, wouldn't always be 50/50, is that right? Or
Well, we don't. Depending on the situation and the fund, it is done differently. I'm not going to get into it now because I know we've
okay,
only
all
got
right,
3 minutes to go. I know another advisor's got some appointments at 12:30, but with our guidance, we can provide further details around that.
yeah.
So you can see here, as I said before, if you have two clients and they're doing a strategy each, include both strategies in the calculator. And you can see I've done 2 rollovers, 2 salary sacrifices, and 2 non-concessional contributions. The way to think about, you're probably thinking non-concessional, tax-free. Why is this counted as a tax deductible strategy? Because you are putting some money from a tax environment, marginal tax, into a tax-free environment. So that's a tax consideration, and therefore there is some tax considerations that you've done for that client. That's the way I've been looking at these strategies. Did I have to think about tax? Is there a tax structure involved with this advice? Super usually is. Then that's going to have a tax deductible proportion to it. Moving across, I just also want to show you this override deductible. You've probably seen it there and going, what is that, Mel? So sometimes you might decide, because of your professional judgment, that a strategy has got a tax component or a tax consideration in it. And I'll give you an example. So rollover, you might say the client's got 2 super funds. One's got an entirely tax-free component and another fund's got a taxable component. Now, if you were to combine those 2 super funds, they're going to reduce their tax-free component, for example. So in that case, you decided to not roll over the funds or maybe only roll over one fund. So in that case, there is a tax consideration. So you might say, hey, Craig, I'm going to make this 30% tax deductible, and you can override that tax deductibility. So that's what that's for. So you can override the licensee settings. If you're not sure, just ask Craig, but that's what that function's for. Then we've got the super and personal selling. Let me go back to this column here. So what I've done, and this is where I think you can apply your thinking and make it really positive for the client. I can see here that if I put this as personal, that a rollover is a capital thing. It's got 0% tax deductibility. So in my mind, I'm thinking that 660, I'm going to attribute it to this one. It's sole purpose okay. It's 660, makes sense to attribute it to that one. And that way the client can get the tax deduction for the other strategies which are tax deductible. So I'll stop there if there's any questions on that.
Yep, I know we're right on 12:30, but
Yep. No,
so
I can go.
in terms of if you're overriding it in that guide that Mel showed earlier, yes, you do need to justify your thinking in a file note or somewhere that why you've overridden it and what your basis is. If you're going outside of that, it's really for yourself more than anything else. The tax office questions something. You want to be able to justify why you've come up with a different answer.
Yeah, and you put it in this column here. So otherwise, this will come through saying it's not tax deductible, but it is in your case. Override that text there. So when it comes through in the letter, and the breakdown rather, you can see that that new text has come through on that breakdown summary. So it makes sense that why it's tax deductible. Tax deductible.
Yep. And in
Um,
that booklet, there is some extra guidelines about how to do that as well.
Correct. So you can see here, it does a calculation for both clients. If it comes from super, it won't count it. And it'll do the estimated tax deductible there. And again, from the question we had earlier, here's an
Mhm.
example of two clients. It just breaks it up between the client and the partner.
Yeah, fantastic.
I'll
All
leave it
right.
there, Craig, in case, let me go back
Yes, excellent. Yeah, was there anything else you wanted to mention, Mel?
is there anything else?
Sorry,
No,
was there anything else you wanted to mention? Is that?
no, I think that's all. So,
Yeah.
yeah, it should be fine. They just my biggest thing is save it as, make sure you're not overwriting data. And if you have any problems with the macros and you stuff something up, just let me know and we can get
Mhm.
that fixed. Yep.
Yep, great. No, thanks for that. Yeah, thanks, Conrad, and thanks, Mel, for taking it through it. Look, it is a complex situation. There's no way around it. It is what it is. But it is an extra benefit to your members. That's something managing your tax affairs is a lot broader definition now than what it used to be. So it is an opportunity to make your advice more affordable, and then that potentially makes it more accessible as well. So thanks for taking it through that. That was a great webinar. This is going to be available on the Ash, as well as your video demonstration of that calculator, Mel, is also going to be
Yep.
available on Mel, and also our guidance and instructions as well, all available from Monday. So thanks very much for joining us today. Thanks, Conrad. Thanks, Mel. And I'll be
Thanks, guys.
speaking to the
Appreciate it.
leaders about any future follow-up questions you may have in relation to this guidance. Thank you.
Have a great
Thank
day.
you. See
Bye.
everyone.